Hey folks, welcome back to Total Money Management. It's a little bit of a different one, like as always, without introducing him. I'm back with Steve, but how you going?
Good, mate.
I feel guilty for not asking you every time. How you going? We've been sat here for 2 hours.
Well, if I wasn't good, I wouldn't be.
We've got a bit of a different construct over the next 4 weeks. This is a masterclass called How to Think About Investing, and it's something that Steve delivers usually within the first few months of someone signing up or joining us.
Yeah, it usually depends. It can come at the start. I often find it's better at the end.
Yeah,
because it's
people get the principles.
Well, it's fairly comprehensive and
so
brings it all together.
Yeah, no, it's an interesting one. It was something we thought would discuss over 4 short episodes and keep them coming over the next few weeks, just to help the listeners out there understand some of the principles that we use. So I might start with a quote from Robert Greene. An emotional response to a situation is the single greatest barrier to power, a mistake that will cost you a lot more than any temporary satisfaction you might gain by expressing your feelings. And that leads into really the first thing that we want to talk about, which is investing versus speculating. So investing is a logical approach, speculating is an emotional approach. And at this point, I might hand over to you to kick into
just
it.
What you find, Jacob, is a lot of people think they're investing when they're speculating, and the difference is important. What investing, as you mentioned, is quite logical, right? So I tend to argue, Ben Graham, who was a famous value investor, right, created value investing. He said an investment operation is one that can be justified on both qualitative and quantitative grounds. Now, what I take away from that is, okay, quantitative means you should see a set of numbers and go, man, that's a good yield, right? Oh, this thing's yielding 8%. Wow, that's really good. Qualitative might be, this is a really solid company with a 100-year history, and at the moment it's cheap, right? That's qualitative. It's a good company. It's got good management, right? So think something like Coca-Cola, right?
Yep.
Solid company, long history, good market share, blah, blah, blah. Okay, that's an investment. Speculation, Graham says, is an investment in stocks, property, etc., in the hope of a gain, but with the heightened risk of a loss. Now, that I can use that at the current circumstances in stocks, right? Or I could say in property. You're buying a residential property, it's yielding 2%, but you are hoping for a capital gain.
Yep.
That's not investing. That's speculating. Now, Graham said, look, it doesn't mean all speculation's bad. You can have sensible speculation. But what I'm trying to show people there is, again, how to think about when you're investing to say, okay, am I investing or am I speculating? Now, as I said, there's nothing wrong with speculating. Just be aware that you're speculating.
Do I have a systematic process?
Yes.
Like, do I actually understand what I'm buying?
Yeah.
Classic example here for the speculative side, and sorry, Jordan, if you're listening from England, but he messaged me this morning. He's one of my best mates.
Right.
He messaged me this morning saying, oh, mate, one of the lads at work's talking about this specific cryptocurrency.
Right.
And it's done about 90 gazillion over the last 12 months. And obviously that's why everyone's talking about it now. And he's like, I've got this much money. Should I put it in there? And I just said, no. When are you going to get out? And I think we spoke about it last week.
Yeah.
And he had no idea. So it's when the taxi drivers start to talk about it.
Yeah.
That's when you got to have a bit of a red flag going off.
Yeah. It's a really simple way. Speculating is not systematic, right? It's serendipitous, right? Oh, here's a chance to throw some money into something. It's now oriented, and what I mean by that is all the stories dominate the numbers, right? I.e., if you look at a residential property and you're negatively geared, what you're doing is saying the story is, we got the Olympics coming and it's growth, or NVIDIA is, it's going to take over the world with AI. Oh, right, okay, and you ignore the numbers because again you're thinking, but the price is going to double, right? Investing, when experienced investors who are really serious using big money, they don't go on speculation stuff.
No.
Right? Or if they do, they're going to use a little bit over the short term.
It's there's an asset allocation amount where you're like, I've got $100 million. Yep. I might put 100,000 into this speculative thing down here, and everything else has an approach. That way, it's hedged. But speaking about risk, we've got the next slide here, which is more internal and external factors.
Yes.
The words aren't up. And just for the listeners, this will be uploaded on our website. It's quite a comprehensive slide deck of 28, 30 pages. And if you want to download it, let us know, or just head to the website and we can send you it out. But this part here is about understanding yourself, right?
Yeah, there's four. I look at, like you said there, internal, external, right? So when I look at everything as in thinking and actions, right? First, it's best to think first and then to act, right? In a logical manner, okay? You think about investing and then you realise you're speculating, right? So what I'm talking about here is there's four facets of risk. This is my choosing. The first one is personality, and we talk about the 9 types in the Enneagram, right? You really got to know yourself. The reason why is because if you don't, you're going to make mistakes.
Yep.
Right?
You can't catch yourself then.
That's right. Yeah. You can't be introspective enough to go, oh, hang on a second, am I doing this because, I'm bored, or I just got some money and so I decided I want to invest. Stocks are falling. Oh, my God, I got to get out, right? Number 2, so that's important, and how much money you've got, right? We'll talk a bit more about that in the next slide. The next one is market knowledge. Do you actually have market knowledge? Do you know about market cycles? Do you know about mean reversion? Do you know how to rebalance, asset allocate, that sort of stuff?
History.
The biggest problem is people mostly over-allocate, right? And it's because they don't know what they're doing, right? Okay, so that's the Jacob stuff. That's Jacob can look after market knowledge, right? Read a book, get smarter. Or Jacob can understand himself so he knows what his risk tolerance is.
Yeah, that's internal.
Okay. External is market cycles, right? Jacob dead, doesn't matter, market cycle still goes on, right? That's the way it works, right?
Thanks, mate.
Right, no problem. So that's a really important facet, because what I'm trying to explain there, and this is probably the critical point, you can be the smartest dude in the room, but if the cape's at 39 and the market's had a 15-year bull run of 500%, it's going to be really hard for you to make money. Okay? That's the point of market cycles. You have to know where you are, because if you think you're a genius buying at the top, you're going to get your bum handed to you on a plate, right? The fourth aspect is the risk hierarchy, and that's where we talk about, using things like ETFs rather than individual companies, and again saying, if I invest in the Australian stock market as a whole, I'm taking a lot less risk than I am than if I choose a junior specky miner or a mid-cap retailer. So again, when you put all that together, again, you're getting a better framework for investing, not speculating. Now, you can have junior specky miners, no problem. So long as you actually know you're speculating and you're not going, hey, I'm going to put all my money into this junior specky miner.
Yeah, you've allocated the right amount.
Yeah. So that's the sort of important part of it. And so this one is, I just want to make a point here about risk. When you let's use you as an example, right? You're 30 years of age. Oh, okay. Well, Jacob, you should be in growth stocks and you should be fully invested and you should
ride the waves.
Yeah, buy and hold, right? So buy and hold, fully invested, growth stocks, because you're young. And we know, quote unquote, that compounding works over time, okay? My argument is, no, that's incorrect. First of all, we know growth stocks and value stocks generally outperform each other for set periods.
Yeah, they almost pendulum swing to each side.
Yeah. So it might be growth stocks since 2009, but it now might be value stocks.
Yep.
So your growth stocks will underperform, right? So there's the first part. The second part is, I can guarantee you your risk tolerance has nothing to do with being 30, okay? And this gets back to the point previously saying, if the cape is 10 and I'm 75, I can still make a lot of money, right? if the Cape is 35 or 40 and you're Jacob at 30, you're still not going to make a lot of money, right? Because the market's expensive.
Yeah, in an expensive market.
Yes.
You could look somewhere else.
So the risk, your personality and your risk doesn't deliver the return. What delivers the return is the valuation, right? And that's got nothing to do with you. The market's cheap or expensive or mid-price. So again, this idea, what we find is it's like, oh, let's learn about Jacob and his age and, you know, how much income he's got and what's his life plan. And it's like, dude, the market's expensive. Don't get into it. That's risk. It's not determined by, oh, Jacob's 30, so we'll just invest his money for 40 years.
Yeah.
Right? So that's what I'm trying to sort of get across.
Well, I think we might have it in one of these, maybe the next slide, which is if you invested from, 2000 to
25?
You would have earned X versus if you waited till
Well, you earned about 4%.
Yeah, 4 or 5%.
Yeah, compound.
Correct.
Right?
But if I
Which
invested in 20...
not really good.
No, well, it's average. But if I waited and invested in 2009, it's what?
12 and a half.
Yeah. So you made more in 15 years than you did in 25 years.
It's exactly right. That's why I say to people, compounding's not about time. It's about the rate at which you compound.
Yep.
Right? And that's the really, really important point there, which is, again, if you invest when the market's really high, you're generally speculating. And the reason why is because you've probably been caught up in a bit of a fever. Hey, AI, NVIDIA, robots, you know, I'll get in. The market's really expensive. And so that's where valuation's really important.
I remember years ago when we were chatting, something that hit me between the eyes like absolute ton of bricks was you showing me the time frames, like, because I was of the opinion, 8, 9, whatever years ago, that you just buy and hold and you can't time the market. But then you were like, no, you might invest for 20 or 30 years.
Yes.
Not 100 years or 200 years. And these change significantly. And like that's something that just rings in my head.
Yeah. The 20-year, the one thing they do is say, oh, Jacob, if you invest over 20 years, you've never lost money. And that's correct. The only problem is there's been periods where you've made 2%.
Yeah.
Where you go, okay, that's as good as losing money in real terms.
Yeah, sometimes you make 2 and the other times you've made 18.
Yeah. I put a long-term chart of the S&P up showing the periods where it's gone nowhere over extended periods of time. I'm talking 30 or 40 years, right? And this is why I say it's really important because what they do is they say, oh, yeah, but you never lose money over 20 years. It's, well, no, but your return can be so miserable that you've actually gone nowhere over 20 years and you shouldn't have been in the stock market. You should have bought a property, right? Or you should have been in gold, right? So that's the thing about the time frames and valuation, right, that they don't teach you. And again, they're being lazy by basically triggering people to speculate rather than invest.
Yeah, or fund managers just say, we'll look after your money and buy and hold.
You can pay me for it. So that's the main point there.
And then the last one for this session is base rates. So skill versus look, really. Like you're not skillful, it's just a bull market.
Yeah. It again, the hardest part of investing is that stuff at the front with Robert Greene, right? Like keep you feel, temporarily you feel good and then you end up trashing it, right? And so investing is really a cold, logical process which says, I've got a time frame, I understand what I'm doing, I've got a checklist, I've got a systematic process. Someone comes along and says to me, like we were talking about, I think in the week that was, about Bitcoin, right? I don't get it. I don't invest in it because I don't get it, but I don't need to. I've got my systematic approach and that's what works for me.
Exactly, yeah.
You've got your approach and that's what works for you. So that's why I say you've got to develop a systematic approach because then you're able to say, no, thanks, that's not the way I invest. Oh, Steve, you should invest in, gold hedges in the Bahamas. It's like, no, okay, thank you, no thanks.
It doesn't really matter what it is as long as you've got an approach and it's returning.
Yes. And importantly, Jacob, that it works by by what we're talking about is those principles, right? Well, does it work over 10 years? No. Okay, well, why didn't it work? Oh, because it was too expensive. Okay, so valuation's important. Oh, right, okay. Well, what else is important, right? That's the sort of thing you want to think about. That will develop your skill and reduce the amount of luck that you're relying on, right? And that, again, is really, really important, because if you want higher returns over the long term, you've really got to be able to understand that stuff, because everybody can get lucky once and you can get lucky in a bull market. The problem is you don't know it, and that's where you get into trouble, right? So there was a lot of guys in the GFC. John Paulson was one of them. Michael Burry was another one. These guys made a contrary call to the GFC, right? Yeah. And they said, oh, it's all going to blow up, it's all going to hell in a handbasket. And they were right, okay? But then after that, they've been really, really wrong.
Right, and they've been calling the...
Paulson said it's all going into gold, and gold went nowhere for like 9 years, right? Another guy who was a hedge fund manager, he was talking all this garbage about, writing these newsletters about ancient Greece and all this crap, this philosophical sort of bullshit, and it's all going to, we're all going to die. And of course, the hedge fund went to hell and didn't earn anything, right? And he closed it down. It's like, okay, well, he obviously didn't realise that he got lucky.
Yeah.
Right?
Yeah. So what can people do to increase their skills? So there's obviously learning about, but what are a couple of good books that people might want to go and read?
The one book that's a real good foundation is Robert Shiller's Irrational Exuberance.
Right.
Right. He talks about stocks, he talks about bonds, and he talks about property, right? And they're the three main ones.
Yep.
He gives you a historical overview of those in about the first 4 chapters.
Yep.
Then he goes into his position, which is narratives, right, drive stocks, which I tend to agree with, right? So then he talks about new era investing, right, like we've got now. Oh, Jacob, it's all AI, it's going to take over the world. Well, this is exactly what happened in 2000, right? That's why I say the older you get, the more you go, oh, God, here we go again, right? Because it's the same thing,
yeah,
right? The other book that is really good, and I don't mention as much, is a book by a guy called Ed Easterling.
Right.
Easter with Ling on the end.
Okay.
And it's called Probable Outcomes. It's a really, really good book like Schiller's. He goes a little bit more into what makes up stock returns, which is, dividend, capital gain, inflation, interest rates. But again, really good background knowledge. And they talk about, Easterling talks about this thing called rowing versus, what is it? Sailing. Right? Rowing is in a bear market, right? So you got to put in some work and you got to row, right? In a bull market, stick the sail up, pull the oars in, and just let that sucker run, right?
Yeah.
And that's really, really useful information, right? And I use some of the slides in some of our lessons because he shows the difference in bull markets and bear markets,
right?
Okay. So talking again about you at the start. It's no good saying Jacob's 30, he can just run in growth stocks forever, because it's like, well, hang on, dude, there's these bear markets and...
I might end up with a 3% return.
That's right. I made 12 for 10 years and then I made 1. And it's like, oh, okay, so you made 6 for 20. That's what I mean. That's where you've got to look at bull and bear markets and go, okay, the valuation's crazy. I'm probably going to be in a bear market. I'll go and buy a residential property that's yielding 6.
Yes. And then on the skill versus look track, the Nassim Taleb's Fooled by Randomness talks a lot. I've read it 3-4 times and I learned something new on the skill versus look point.
Yeah. He's really, you could read Taleb's books front to back, go back to the front, go to the back, go back to the front all the time, and it's just really enlightening.
He just makes really good points.
Yeah, he's just got really good stuff, But it's pretty, look, I'm not being rude, but it's pretty basic statistics, right? It's just talking about the normal distribution, what we're talking up there about base rates, right?
Yeah.
Power laws, You know,
Yeah.
so is the market like an earthquake where you wake up one day and you get a tsunami, or you get a 7 on the Richter scale, or is the market like the normal distribution where you get this sort of randomness that keeps things fairly level, right?
Well, yeah, taking things that are quite complex and making them simple
Yeah,
is
yeah.
a real skill.
Yeah.
So, cool. All right, well, I think that might wrap it up for the first session.
Yep.
Tune in next week and we'll continue. Again, it's a 4-part series, so you'll have to wait a month before you listen to it all.
For the exciting end.
Yeah. All right, thanks everyone.
Cheers, folks.
As always, remember, we don't provide financial advice.